Hello, I'm David Chaston from interest.co.nz. I'm here today with another double shot interview and with Terry Haydon from Cashflow Funding. Terry's been in before and we're talking about how small businesses can get better value from their working capital funding lines. Last time we were here, Terry, we talked about the cost of that. A lot of that is pretty opaque, but today I want to talk more about the volume of it. How do you get it and what are the limitations that you get stuck into, really?
Well, I think it's pretty important with the economy as it is at the moment, sort of picking up growth. It leads to the question of, particularly in SMEs, funding day-to-day activity and growth. So one of the major concerns, I think, for small businesses, or any business for that stake, is funding growth and day-to-day activity. And really that's what is a main issue at the stage in which I like to address.
Yeah, well, it seems to me overdrafts, most small business overdrafts anyway, are based on property and they're very much fixed to the value of the property. How do you get around this problem of your working capital funding for your business basically being a fixed loan when your business is growing?
Yeah, I think that's a major problem because, as you say, one of the big problems is funding working capital. And you've got to go back to what is the definition of working capital. And working capital really funds the difference between buying the raw materials, converting them into product saleable and waiting to be sold. It's usually a sort of a 30, 60, 90-day roll, and from our perspective should be secured on the very assets it's financing: debtors, stock, working capital. But they're significantly and notoriously hard to secure, and that's probably why a lot of commercial banks lend on property. And they're basically your problem, because that is a very restrictive way to lend on an SME.
So how do you secure it?
Well, we prefer, and we think the right way to secure working capital is basically on the current assets, or liquid assets, as I said before: debtors, stock, working capital, work in progress. But the main issue with the current restrictions on lending on property for small businesses is quite prohibitive. Firstly, you get a situation where if the banks do lend on property, it has no relevant effect on the growth of the business. It's a limit on the property, not the business. And generally the bank, the second restriction, because it needs to protect its cash flow to support the loan, will put a general security agreement over the business, thereby restricting its ability to fund on its own assets. And thirdly, the banks will always charge a premium on borrowing over property to go into business. So there's three basic restrictive elements of funding on property, where we believe it should be concentrated on the current assets of the business, which are those we're trying to fund.
Right, and when you lend against current assets, that's a secured lending as well, is it?
Well, the security of current assets is notoriously hard to secure. It's very administrative content and a lot of process. Yep. The closer you get to cash, the harder it is to secure. But quite honestly, that is the way to go, and we believe that from our business point of view, we've been able to secure that and been able to offer a much better, not only lending, volume of lending, but rates. For example, I mean, the greater the security, the lower the risk from our perspective. Yep. The lower the risk, it follows on a better rate for our customers, and indeed in many cases a much larger lend. So I think the methodology that we have of borrowing working capital against property is wrong. It should be based on the companies. Yep. And the only reason that is so, because from a bank's perspective, they are not geared to secure against the very fast moving current assets.
So as working capital grows, does that mean that your ability to lend more on working capital as the business's assets grow?
That's exactly right, because where you're restricted on the value of a property, and your business might outgrow that, what we offer is as the business grows, so does its current assets, debtors, stock, and that's what we lend against. So it's ongoing.
So there's just a different process. Instead of going through the process of the bank, you're saying, which is property focused, you go the process with a company like yours, which is working capital focused. So presumably there's a whole series of application aspects that you have to think of that are different to the way you'd apply for working capital in the bank.
Yeah, but I think really a small business should be securing on its current assets. If it's lucky enough to have stock of property available, it should be able to use both.
Yep.
And quite honestly, you mentioned before a calculator. If you look forward to look at the calculator we introduced, it's on interest.co.nz, and you run either whether you have property or without property, it's quite remarkable the changes we can make without property or even with property. So it's advisable that people have a look at that and run through it.
Thank you for that, Terry. I'm David Chaston with interest.co.nz. That was another double shot interview.